Welcome to Finance Central. मेरा नाम है जगू and I'll tell you all about markets, investments, finance and much more that you would love to know about money beyond the usual headlines. मैं try करूंगा to make it easy for you to understand some important financial concepts जो आपके लिए जरूरी है पर बाउंसर की तरह निकल जाते हैं। चलिए अब बात करते हैं म्यूचुअल फंड्स की और बताते हैं आपको इंटरेस्ट रेट्स का इंपैक्ट म्यूचुअल फंड्स पे कैसे होता है। First of all, if you're new to mutual funds, let me tell you in simple terms that there are majorly two types of mutual funds, equity funds and debt funds. It's simple. Either you can invest in stocks directly through a broker or you can give your money to an expert fund manager. When a fund invests your money into equities, it is called an equity fund. Similarly, if a fund invests your money in debt securities like bonds, it's called a debt fund. Return on equity funds goes up and down as the stock market rises and falls. This year so far, stock markets have been falling all over the world. If you ask an expert what is wrong with the market, they'll tell you it's rising inflation and rising interest rates. Kyunki if EMIs go up, some buyers may postpone their plan of buying a new house or a car. A lot of big ticket shopping happens on consumer loans and personal loans these days, and with rising rates, some of these consumers may defer their plans. Now, what is the impact on the stock market? Companies building houses or manufacturing cars or two-wheelers, TVs, fridges, etc., they will find that demand for their products is slowing down with rising interest rates, meaning their revenue and profits will grow at a slower pace. If you ask me what is the single most important factor that drives the stock price of a company, I would say it is the profit earned by the company. And not how much profit the company earns, but also how fast the company is able to grow the profit year after year. As we discussed, with rising interest rates, if profit grows at a slower pace, then the market offers a lower valuation for the company. And that's not all. If companies want to grow their business and profit year after year, they need to invest hundreds or thousands of crores for setting up new factories, etc. The rising interest rate forces some companies to postpone or drop new projects. When investors see that a company is not expanding or going slow on an expansion plan, they assign a lower valuation to such companies. With rising inflation, the cost of production goes up. But it's difficult for car makers or paint manufacturers to pass it on in a rising interest rate environment. Instead, they take the hit on their own margins to retain customers. Now, what is the end result? Lower profit and lower stock price. However, this is also a good opportunity to buy into equities due to their lower valuations. Then you look forward to growth in the future. And what about debt funds? Debt funds usually provide a steady flow of interest income. In fact, the return comes with tax efficiency too. But when interest rates go up, as they have been in recent months, bond prices may fall and your debt fund may not yield as good a return as you would have expected. To make it simple, let me tell you the basic principle of interest rates and bond prices. अगर रेट बढ़ेगा तो बॉन्ड का प्राइस गिरेगा और रेट गिरेगा तो बॉन्ड का प्राइस बढ़ेगा, something that we call an inverse relationship. Now bonds come with different durations. That is, the time it will take to mature and return investors' money. The second mantra you need to remember is that when rates go up, a 5-year bond will fall less than a 10-year bond, and the 1-year bond will be usually least affected in comparison to 5-year or 10-year. The RBI or the US Fed generally announce a series of rate hikes over several months or quarters. So, if the bond is going to mature in 3 months, there could be at the most one more rate hike during this period. But if a bond is going to mature in 5 years, rates may be revised 5 to 10 times or more during this period. One must note that bonds are always redeemed at the face value or the price one pays while buying them. Suppose you purchased a bond for 1,000 rupees. The bond carries a coupon rate of 6% and matures in 5 years. You will get 60 rupees every year for 5 years, and at the end of 5 years, your bond will be redeemed at 1,000 rupees. The problem arises if you need the money in, say, the third year. If rates have gone up in the meantime, it is possible that the market price of the bond could have fallen to say 950 or even 930 rupees. So somebody who will sell the bond in the third year will get only 930. But if they hold on for 5 years, they will get the full 1000 rupees back. Now, it is easier to hold on to a bond for 1 year and redeem it. However, if you're holding a 10-year bond, there is a high probability that you might need the money after 2 years or 3 years and end up selling the bond in the market rather than waiting for redemption after 10 years. That is what makes a 10-year bond riskier and more volatile as compared to a 2-year bond. Similarly, if you're holding a bond that pays 6% per year and rates have now gone up to 7%, you will be losing 1% every year. On a 2-year bond, your loss is limited to 2 years. When your money comes back, then you can invest it in a higher interest paying bond. However, on a 10-year bond, you will have to be content with a lower interest rate for 10 years. So the market price will reflect this loss and will fall more. Thankfully, there are funds in the market that invest only in short-term bonds. Also, some funds invest in debt securities maturing within 3 to 6 months. If you go to a financial advisor and if they suggest ultra short-term and liquid funds in a rising rate environment, you should know that they are talking about shorter maturity funds. तो ये था आज का Finance Central episode. Our objective is to make finance easy and accessible. We really hope that you learned something new from today's episode, and if you did, do share the gyan with your family and friends. I'm sure they'll be impressed. And if you're watching this on YouTube, do remember to like the video and hit the subscribe button. Ring the bell so that you are notified every time a new episode is uploaded. Thank you and see you soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.